Welcome back to Insurance Mantra in our Expert Speak segment. Today I am joined by Ashwini Ghai, a respected name in insurance industry, a former executive director of LIC with experience of more than 37 years in insurance industry, life insurance industry. Thank you so much Ashwini Ghai sir for coming to our studio sir for the Insurance Mantra show. To begin with, I just want to understand, because in this segment and in this show we are focusing on life insurance, and we often talk about the protection gap. So what actually is the protection gap? Can you explain to our viewers?
Thank you for having me, Anurag. Basically, protection gap is a person, when he is doing his financial planning, he looks at what are his goals. Then he looks at what is the rate of saving that he can do with his income and what kind of investment can he do. And within these two, there might be gaps of cash flows coming in or likely happening of certain events which can derail the financial planning. That actually is the protection gap, which is to be filled in, and normally insurance is one big chunk of taking care of that protection gap.
Okay, so that protection gap can be filled by life insurance only?
It can be by life insurance, general insurance. Basically, health and life insurance are the two main components of taking care of that protection gap. Other insurance also takes care, but mainly these two.
Okay. And sir, life insurance also you have said, and in life insurance when we speak, there are types of life insurance. Term insurance, we know that it's a pure protection plan where you pay premium for so many years and something happens, then insurance company gives claim. But there are other types of insurance plans also, whole life insurance, endowment plan, and unit link insurance, that is ULIP, which is popular. But can you explain to our viewers about the whole life insurance and endowment plan?
Basically, when we look at life insurance plans, there are two types of plans, rather three types I would say. One is pure protection, one is protection plus saving, and one will be, which is what we call annuities. When you survive longer, which gives you annuity over a period of time. Within these, when you look at whole life can be either a protection only or protection plus saving for full life. Premium paying term could be lesser for 10 years, 15 years, 20 years, and after that the protection continues for the whole of the life of the person. Okay. So that is one. Second is, you talked of endowment. Endowment is another type of a plan where it is protection plus saving mainly. What happens is you target a date on which you require a maturity or cash flows, and those cash flows are taken care of by the endowment plan. Okay. And third will be ULIP. ULIP is again a basically protection cum saving plan, but it is market linked. Here there is a concept which is going on to understand this, something called a participating policy and a non-participating policy.
Okay. Please explain that also to our viewers in a simple terms.
Simple. Participating policy is one where you have protection plus saving. Saving is variable depending on the experience of the company on the investment front. There is non-participating where all the benefits are fixed, including the saving returns are fixed. You get guaranteed over a period of time. You have no risk of investment, so to say. Everything is given you upfront. So these are, yes, upfront.
Okay. So insurance companies focus more on non-par or par?
I would say these are cyclical moments.
Okay.
Per se, depending on the market conditions, depending on the requirement of the customers, how the customer sensitivity is towards interest rates and others, people go in for these kinds of plans. Nowadays, more focus is on non-participating ones, guaranteed addition. Basically, it was part of a cycle where the interest rates had gone up very high. And now it is started to coming down, maybe it may not continue. Just for your information, till about 80s, most of the plans sold by LIC were participating.
Till IPO also,
80s,
sir.
90s, till 90s, and
Till IPO.
rather, let me correct myself. Initially, it was non-participating. Then 90s to IPO, it was participating. Now it is again non-participating.
Non-participating. The non-participating share has increased from 7% to 30%.
Yes, you are talking of LIC.
Yes,
basically.
now LIC. And now, sir, I want to understand from you two basic terms of insurance: free look and grace period. So, how should we read free look and grace period? What is the difference in this?
Free look is one of the very customer-friendly initiatives or the step taken by the regulator. Free look is that after you get your policy, between 15 to 30 days, normally it is 30 days of receipt of policy, you can study the terms and conditions of the policy. If you are not satisfied, you can ask the insurer to cancel the policy, and with minor deductions only, the total policy money is given back to you. First premium paid is there. When you talk of grace period, is again, grace period is something when your premiums are due. The insurers, depending on the various types of policies, allows you that within a certain period after the due date also, you can pay your premiums, but all your life insurance protection stays intact. It is again 15 days to 30 days, depending on the kind of policy that it's there. So it is a grace given to the policyholder.
Okay.
That I continue.
And it depends from company to company.
Company to company and product to product.
Okay, okay. And sir, nowadays with the insurance policy, there are a couple of riders also. So those who are going to buy a new insurance policy, it is advisable to go for riders also?
Riders are now, when we say now, it's not now. For a very long time, riders have been there. There used to be singular rider.
No, I mean to say that popular now.
Popular now. Double accident benefit used to be there. So riders are something which can increase your coverage with minimum premium. So you have a base cover and you can decide on having various riders to add on to risk coverage, a different type of risk coverage to you.
Okay.
So the protection gap reduces by having riders. So rider could be, just to give you an example, a critical illness rider. Suppose somebody takes a critical illness rider by paying something. So there is a basic sum assured. If you don't take a rider, you will not be paid anything if you fall sick. It will be given only when either death happens or your maturity happens. But when you take a critical illness rider, on the date you are detected, from that day onwards, you are given certain fast tracking of the payments to you, plus it could be in installments, which can help, and there could be premium waiver along with it. You need not pay the premium till the maturity of the policy. So it helps you to meet the medical expenses which you are making at that point of time. It comes to your rescue. There could be there is something called a premium waiver rider. Basically, with a child plan we used to do initially, but now it is done with others also. On happening of something to the proposer, the premiums are waived from the date of death of the proposer, and thereafter the risk coverage for the child continues. Benefits continue. Okay. So it is again a beautiful thing. So the protection is that your family will get the money despite your not being there. Even your child's insurance will continue.
Okay. So, and sir, for because we see that a lot of advertisement around that child policy, secure your child's future. So, for your child, it is advisable to go for a child policy through life insurance companies?
I believe when you are in the situation in a fast changing environment like today's, nothing is certain. Certainty is something which is required, and for having certainty, insurance is one of the beautiful financial instruments to ensure that you get the targeted amount at a particular time, even if the markets go up or down or your income is not there at that point of time. So for a child also, I think you should have a policy for your child also. The premiums are minimal, risk coverage is there from a certain period of time, and the child, more than that, when you are having a policy for your child, it inculcates a financial sense of financial discipline in the child when he becomes a major.
Okay, yeah.
That
Financial discipline comes in. Okay. Because most of us, when we talk about insurance and mutual fund, we always regret, Arey yaar, means for so many years we were not aware only. Had been known to me, I could have started a SIP.
We are always late.
We are always late.
Always
so,
late.
so with the child policy, they can be early starters.
Yes.
Thank you so much, sir, for explaining the basics of life insurance, where
Thank
you
you.
covered whole life insurance, endowment plan, then what is the difference between free look period and grace period, and why child policy is also important when we talk about the life insurance. But before we wrap, here is today's insurance basic or our insurance mantra. What are riders in a life insurance policy? Riders are extra benefit you can add to your life insurance plan for more coverage. They give protection in special situation like critical illness, accident, death or disability. So the popular riders include critical illness riders pays a lump sum if you get covered. If you get a covered illness, accidental death benefit riders, extra payout if death is due to an accident, or waiver of premium rider is also there. Stop future premium payment if you become disabled or critically ill. So remember, knowing your policy is the first step to being fully protected. Choose